Hello, hello, Dan Passarelli here. How are you today? I hope you're doing great. Hope you're doing better than me. I'm not feeling so hot today, but that's not going to stop me from sharing some great stuff with you. Before we get started, I want to make sure you can hear me. Please hit that Q&A box and give me a yes if you can hear me. Justin, Julia, Mike, some of the usual suspects, Dirk, Martine. Happy New Year to you. Tomas. All right. Well, friends, today we're going to be talking about advanced time spreads, diagonals, double diagonals, and double calendars. This is a somewhat more advanced class, and you are going to like it. Before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not necessarily specific to your specific situation. Allow me to introduce myself for those of you who are new to the market taker slash Firstrade family. My name is Dan Passarelli, and I am an author of two of the most popular option trading books, with the third one on the way. Many, many articles, many, many webinars and online trainings like this, many online videos. I create a lot of content, as the kids call it. And I am a trader and investor. Been doing that since I was in college, actually. Um, but that was a long darn time ago. I've been there, I've done that, and I'm still doing it. And I am the founder of Market Taker Mentoring, founder and president of Market Taker Mentoring, which is the global leader in option trader education. We have student traders in over 50 countries, if you believe it or not. We've put tens of thousands of traders through our classes, and we've built an army of great traders. Welcome. And I'm a trading industry collaborator. Easy for me to say. I work with all the best actors in the options industry, the best options friendly brokers like Firstrade, for example, as well as all of the option trading exchanges globally. In some capacity, I've had a hand in their, what do you put a hand in? I had my spoon in their soup. I don't know. I've been eating soup lately since I have a cold. And I'm also a family man, excuse me. Those of you who have furthered themselves in your trading with market taker classes, you're familiar with my wife, Kathleen, who is our head of operations here at Market Taker. And I also have my two adult children and my two cute little dogs. I am also do other things for fun besides trading. I'm a runner, foodie, traveler, musician, do a lot of fun stuff. Now, enough about me. Let's talk about the important person here. Let's talk about you. And let's talk about what I'd like to do for you. I mean, first of all, today we're going to talk about diagonals, and double calendars. And we're going to go a little deep. But, you know, you can always go deeper. At Market Taker, we work with people who are both brand new to options, need to learn the right way from the get-go, all the way to people who are already professional traders and want to be even better at their craft. And whichever end of that spectrum you are, or anywhere in between, we're glad to help. So after our class today, just simply go to markettaker.com, go to the top right and click on join free and get started. That is your first step in allowing us to be your partner in investing in yourself. All right. Lots of great stuff to talk about today. We're going to do a time spread review. We're going to talk about double calendars, talk about diagonals, double diagonals, double calendars, double your fun, double your pleasure, double your fun. I don't know if you know this. I have a twin brother. We were Doublemint twins when we were younger. I'm totally just kidding. It's not true at all. Don't even have a twin brother. I have a younger brother. He's 8 years younger than me. Good guy. Lives out in California. He's in the movie business, believe it or not. All right. So let's talk about time spreads here. Hey, I'll tell you what, before we even get to time spreads, hit that Q&A box and give me a Y for yes or an N for no if you've ever traded a time spread before. Hit that questions box for me. Give me a Y for yes and N for no. Oh, really, Mike? That's really, David? That surprises me, folks. Okay. I mean, not that there's anything wrong with it, obviously, you know, but oh, you guys never traded a time spread before. Oh, okay. Well, then I will be careful with the review here. I'll make sure that we are thorough in that regard. Hey, Secret Agent Man's back. Unless it's a different Secret Agent Man. You never know because it's a secret. Could even be Secret Agent 1. So a time spread is also called a calendar spread. Could also be called a horizontal spread. And man, I'm going to tell you something. That's the hard thing when it comes to learning really any new thing, but especially option trading. Like option trading, it's like a whole language of itself, isn't it? We got the Vega and the implied volatility of the Iron Condor. You know, like there's just all these new words and phrases, and learning the words is half the darn battle. It's probably a little less than half the battle, honestly, but it's an important part of the battle. It's the first part of the battle. So it's important to know that these are synonyms: time spreads, calendar spreads, horizontal spreads. And what they are is when a trader, excuse me 1 second. When a trader buys one option and then sells another that is the same type, meaning they're both calls or they're both puts, Both options have the same strike, but a different expiration. So I'm buying one that expires at this date with the 50 strike, selling one that expires at this other date with the 50 strike. As far as the horizontal thing, I always just used to think like right? So much better to have these pneumatic devices, you know? Sometimes I'm bad with names. Like, I'll meet somebody, I'll be like, ah, crap, I should have paid more attention when he said, hey, my name's Chuck. And then a colleague of mine said, well, what you do is as soon as they introduce themselves, you make up some thing about their name. Their name's Chuck. Well, actually, I'm not going to tell you the first thing that came to my mind. Um, if their name's Charlie, with these, it's just two different expiration dates. Expiration dates, time horizon, calendar. Now, you can either buy these or sell these technically. When you buy one, you're buying the option that has more time until expiration. And that's because options that have more time until expiration with all the other same criteria are going to have more value, right? Because let's face it, it's worth more to have the right to buy a stock at X for 2 years than it is for 2 minutes, right? The opposite. You're selling one with more time. But so here's the deal, though. Retail traders, which is most, if not all of you, you're only going to buy time spreads. Selling short time spreads, that's really only for professionals. Why? Because it's really only for a couple of reasons. One is because the way that margining is set up with the clearing firms, they have to margin you a lot. Means it costs you a lot to put on a short time spread. Then you're left with a naked short, which has huge margin, right? So they have to just start you out with huge margin. So that being said, oh, and the other thing about it is, and let's see, do we have no, good, I took it out. Looking to see if we had a slide on a short time spread. Basically, they're kind of silly for retail position traders anyway. They're really only good for capturing small implied volatility moves with Vega. But long time spreads are really good because you make your money with theta. No time value. We're using a P&L diagram. Incremental risk is using the Greeks. That's measuring changes in the pricing factors like time and volatility and small moves in direction. So this is what we would look at for a profits and loss diagram for a long time spread, a long calendar, a long horizontal spread. Basically, look, it's this. If the stock is between the break evens, you make money. If it's right at the share, why? Because like, let's say this is a call time spread. If it goes way down too far, both options are worthless. If it goes, and then you lose what you paid for it. If it goes way up too high, then both options are 100 delta. They're trading at parity, and the time premium that you paid is what you lose. And then it's just the opposite for put time spread. So, pretty easy to conceptualize, but that's not enough to trade these effectively. There's some nuance to it. The delta, we got to look at the Greeks. When it comes to time spreads, if you're not looking at the Greeks, you're not going to make money in the long run. And I know from doing thousands of webinars over my life, there's probably one guy in the room right now who says, well, I trade time spreads. I don't look at the Greeks. I make money. You go make 500 more time spreads and let's talk. In the long run, it's impossible to make money trading time spreads without using the Greeks and implied volatility and theta. Now, as far as delta goes, it can be positive or negative, and that's because you have negative gamma. And this is a picture of negative gamma. You ever wonder what a picture of negative gamma looks like? This is it. Why? Well, because on this side, you have a positive delta, right? The higher the stock goes up, the more money you make. That's positive delta. Up until the shared strike price. Then the higher the stock goes, the more money you lose. The lower the stock goes, the more you make. And here, the lower the stock goes, the more you lose, right? And it's exponential. Hyperbolic, I think you call that too, right? That's the same thing. I forget. My head's so cloudy today. So, yeah, this is a picture of negative gamma because your delta changes adversely. When the stock's going down, you're losing money. When the stock's going up, you're losing money. Only when it's magnetized towards the middle strike do you make money. So that's why, like, when the stock's below the strike price, that's when you have positive delta. And when it's above the strike price, that's when you have negative delta because of the negative gamma. Simple. So how does money actually transpire and end up in your account? With positive theta. The rate of decay of the shorter term at the money option is higher than the rate of decay of the longer term at the money option. So with the short option, I'm making this much a day. With the long option, I'm losing only this much a day. Net, I'm making this much a day. So basically, it's this little game of cat and mouse. I want to make theta without the stock moving too much, high or low. Vega is a tricky one. It's an important one, but it's one that people oversimplify so much. Man, I was talking to a trader who, I figured was a pretty decent trader, not like a professional, but, just like probably like some of you here attending this class who I knew studied a lot and had some success and said, oh, yeah, I have a time spread. I want implied volatility to go up. I said, why? I said, well, because it's positive Vega position. And it is on the surface. But the thing is implied volatility of each option moves independently of one another. And we'll talk more about that today. We can kind of break what we just looked at down and say the risks we have are direction. And when I say risk, I mean chance of loss, chance of profit. The risks we have are direction. Stock can go up too much and lose, down too much and lose. If it pulls towards the strike price, it's good. And then volatility. Too big of a move, too much magnitude of realized volatility, you lose. A little bit of realized volatility, you win. Changes in implied volatility can help you a lot, but I think we're probably getting the cart a little ahead of the horse here. So let's do a little refresher on volatility here, friends, shall we? So, okay. Geez, this is a small class today. Is it because I sound terrible and everybody just doesn't want to listen to the sicko and they're dropping out? Or are people still hungover from New Year's Eve? What's going on over here? People on ski trips? I wish I was on a ski trip. You know, the last time I was on a ski trip, I got this they call it HAPE, HAPE, high altitude pulmonary edema. Almost died. Do you believe that? It's pretty crazy, right? They say when you go up to the mountains, like when you're going on a ski trip, when you get there, don't drink any alcohol, drink a lot of water, get a lot of rest. And, you know, traders tend to be sort of cavalier about a lot of things. Let's be honest, right? That's a trait of traders. We're cavalier. We like to do things our own way. So I didn't follow any of those instructions. And oh my God, I ended up in the hospital. It was terrible. Got back last Christmas. I was in bed all Christmas. Wife and daughter brought me some soup in bed. Merry darn Christmas. But this Christmas, it was fun. I was all healthy until now. So, anyway, there's two types of volatility. There's realized volatility, which is also called historical volatility or statistical volatility or just the stock volatility. There I go with the nomenclature again, but like I said, it's important stuff. You got to know it. What it is how much the stock has moved around lately. And they just measure that with annualized standard deviation of technically daily returns. I say of an asset price, a little bit of an oversimplification. Daily returns is technically it because we use a log normal distribution. But now we're into real math nerd stuff. Next, there's implied volatility. And implied volatility is basically how cheap or expensive the options are. Now, you might look at that and say, what does that have to do with volatility, Dan? And you would be right in asking that question because it's a good question. I still ask myself that question sometimes. It stems from the idea that when Fisher Black and Meyer and Scholes were trying to put together the options pricing model back in 1970, was it 72 or 73? I want to say it was 73. I think it was 73. There's a lot of financial stuff happening in 70, right around then. So when it got off the gold standard, when the pricing model came out, when options were first listed, man, what would it have been like to have been a trader back then? Wouldn't it have been interesting? It's interesting now with all the algos and crypto, the explosion of options volume and interest. But people tried to create an options pricing model before then. And they knew, hey, if the stock goes up, calls go up. Stock goes down, calls go down. And they knew, hey, if time passes, options are worth less. And they knew, hey, if the interest rate changes, well, that affects calls and puts because, it affects the interest on the cash or the opportunity cost on the cash. They knew all these things, but then there was this like extra factor. They didn't know what it was. So Fisher Black and Myron Scholes figured, well, people buy or sell options based on their expectations of future volatility. Like if they expect volatility to be higher in the future, obviously that's a better time to buy options. Like that's clear, right? If they expect volatility of the stock to be lower in the future, well, that's a very bad time to buy options. It's a good time to maybe short options. So they said, aha, there's the metric, the criterion that we've been looking for. Volatility. Aha. That's what we'll call it. But in my opinion, they kind of took it a step too far and made an assumption that that's the only reason why people buy or sell options, and it's not. I know for a fact there's a number of folks in this class right now who have bought an option, never even looking at a volatility chart or the implied volatility in the option chain, right? So that's not the only reason people buy or sell options. So really, if I were king, and I'm not king, but if I were king, I would change that factor that Vega measures, and I would change it from implied volatility to, well, I mean, I guess if I were king, I would just call it the Dan factor, right? The pass factor. But, you know, again, not king. You can't be king, right? So it's really just a measure of supply and demand that they call volatility under the assumption, because they were professors and not traders. When Myron Scholes finally decided to become a trader, he screwed it up 6 ways to Sunday. So yeah, it's really the supply and demand factor, but it's interpreted as the market's estimation of future volatility in an asset. It's the volatility implied by option prices. And there's the term structure of volatility. So volatility, okay, so this is interesting stuff here. Hold on a second. We're gonna need a chart here. Hold on a second. Oh my gosh. Thing keeps popping up over here. I want to punch it right in the face. I never know how to turn this off. I just can't figure out how to turn it off. All right. So options. Let's look at what's a stock. Let's look at Netflix. Get option chain. Then we'll go to, from chain type, we'll go to Greek/analytical. And we'll look at 2 different expirations. Now there's a column here, IV. That is not Roman numeral 4. That is not an intravenous tube. That is implied volatility. So interestingly, each one of these calls, each one of these puts in both expirations I pulled up, they each have their own unique implied volatility. Isn't that weird? They each have their own implied volatility. Geez Louise, why is that? Because if you think about it, If you were going to buy a call on Netflix, and let's just start with like January 30th expiration, 23 days to expiration, if you're watching this live. If I thought Netflix was going to go up, and it's just hypothetical, I don't have an opinion on it. It's an especially nuanced one with this whole takeover thing that's happening for those of you who are, again, watching this live. Netflix being a potential suitor, not a target. But if I thought Netflix was going to go up, I could buy the 92 calls. I could buy the 94 calls. And would it really matter that much? Not really. Not a lot. But it would matter a little bit. On one of them, I would make more money than the other. Which one? Depends on how much it goes up and over how much time, right? One has a bigger delta, one has a bigger theta. So it doesn't matter a lot, but it matters a little bit. So the implied volatilities, which is the supply and demand metric for them, should be similar, but not necessarily the same. So each option has its own implied volatility. And there's a method to it. Like it wouldn't be reasonable for the 92 calls to have a 45.96 volatility and the 94 calls to have a 10 or 100 volatility. Like they're just not, they're much more interchangeable than that. So it tends to be like a smooth line when we're looking at this vertical skew. Horizontal skew or time skew, same words as the time spreads and horizontal spreads. Those can sometimes be pretty different when we're looking at the same strike, the 91 calls of each. This one's a 27.73 vol. This one's a 45.56 vol. Would this make a good time spread? Oh, let's look. We're talking about the term structure of volatility, which is the observation of the volatilities of an option of different expirations on the same underlying. So the idea is when I buy a time spread, I'm buying an option in one expiration, selling options in another expirations. So I'm getting positive implied volatility exposure or vega in one, negative implied volatility exposure or vega in the other one. And so if there are correlations between the two, then I'm going to pay attention to that because I mean, they have a correlation, but there's also a time gap. Like if I expect volatility to be high 5 weeks from now, the options that expire before 5 weeks aren't going to account for that. But the options that expire after 5 weeks are going to account for that. So their implied volatility would probably be higher. This enables me to trade for value. Enables me to get an edge. I'm trading volatility. I always want to buy the low volatility and sell the high volatility. But back to Netflix, if I'm going to buy this time spread, buy the 91 calls at 45.56, sell these shorter term 91 calls at 27.73. That doesn't work. There I'm buying the expensive ones and selling the cheap ones. So in Netflix, it sets up for a terrible time spread. All right, so let's get into double calendar. So a double calendar is nothing but this. Well, first of all, it can also be called a strangle swap. But a double calendar is when I buy one call and I'm just going to skip the business about the short calendars. All we're going to talk about is long calendars. So I buy one call with expiration A, sell another one with the same strike, but a shorter term expiration B, and then buy one put in expiration A, which has the lower strike, and sell a put of the same strike in expiration B, the shorter term. The calls are out of the money, the puts are out of the money. So calls have a higher strike, puts have a lower strike. So if you think about it, it's basically two time spreads, right? Call time spread and put time spread. So this is the same criteria as setting up a regular time spread, which I know many of you have never actually traded before, but we've done some coursework on it. We've done some workshops on it, and you should be familiar anyway with it. Clearly not an expert at this point. You can be at some point, but not there yet. But you're familiar with it. So we're going to analyze the chart, looking for a sideways chart. Analyze the volatility events that are expected, like earnings or Fed announcements. And then look at the volatility, analyze the volatility, chart and otherwise. So these prices are not current, and this is by no means a recommendation. It's just an example. In this case, Apple is trading pretty much sideways for a bit. Now, realistically, I don't like this big long wick up here, but if we pretend that didn't exist, this would be a pretty good candidate for a short-term time spread potentially. We just want to see that it's trading somewhat sideways. I mean, I really love it if there's resistance above, which maybe there's a little bit, and support below, which maybe there's a little bit. And then here, we could think about trading an at the money time spread. Oh, here, let's back up a second. So this is with the stock at, yeah, let's just say it's at, well, we'll look at the 275 strike. We could buy the 13-day 275 calls at 214 and sell the shorter term ones at 98 cents. So buy the longer term, sell the shorter term. These are 1 week ones. And then because the stock was at 270, note that these are out of the money, 275s. Then we could also buy the 265 put time spread. Right, 265 puts at 185 in the 13 days to expiration, and then the, I said 6 days to expiration. Sell the 265 puts at 86 cents. So again, just going back here, stocks basically at 269 for the last. You just call it 270. Going $5 out of the money to the upside and buying the call time spread. $5 out of the money to the downside, buying the put time spread. So, little recap here. Selling the January 9th 275 calls, buying the January 16th 275 calls, selling the January 9 265 puts, buying the January 16th 265 puts. So the total debit being paid is $1.90. If I were to add up and subtract out all these prices, debit for this, credit for this, debit for this, credit for this, and when I put in this order as one order, put this in as one order called a double calendar, there would be a bid and an ask for that double calendar, right? So I would try to go kind of close to the mid market. I say mid market ish because I'm paying a debit. I'm going to want to bid just a little above the mid market. But here's the thing. Who is, hey, who can answer this? Who is on the other side of your trade? If you buy this double calendar, who sells you this double calendar? What's the name of their job? Not their actual name. Not like, Johnny Smith or something like that. Nice work, Justin. Market maker. Exactly. Tomas, market maker. Boom. And that was my job for a long time. I was a market maker. They're slowly kind of changing the name to dealer now. So if you ever hear somebody refer to a dealer in market makers or in options, it might be meaning market maker. Just an FYI. I still say market maker as well because I don't know. I think technically that is still what they're called, but sometimes people say dealer. So yes, anyway, the market makers, they think of things in terms of volatility. And they're always buying this and selling that and buying this and selling that. So you might think, well, Dan, if I'm buying the low volatility and selling the high volatility, I see the edge in that. I see the advantage in that. Why would a market maker, professional trader do that if they're trading based on volatility? Well, it's because they're in and out all day long of both expirations. And so, if they can sell you the January 16th options at this volatility, but then buy them from somebody else who's selling them at this volatility, they'll do that and do the same thing in the other one. And don't worry about them. They're going to make their money. They're going to figure out how to do it. And they're, they're good at it. They're professionals. So you can do that. So you should try to trade mid-market, but you always have to give them their due. Otherwise, they're not going to trade with you. Just like, when you go to the car to buy a new or used car, if you're the kind of person who likes to bargain, I'm the kind of person who likes to bargain. John and I were in China once teaching an options class to some members of their exchange and their brokerage firms. And our host took us to this really very cool old walled city. And it was very traditional and really just beautiful and amazing. And we have a friend who has a daughter who is special needs. She's autistic and she loves Chinese fans, And so I'm like, but she breaks them a lot, So it's a gift that we recurringly give, And so there was a shop that sold fans. And so I'm like, oh, I'm going to buy some fans, I'll just buy a bunch. They're pretty inexpensive. It was like, a couple bucks a fan or something. And, my host is like, oh, you can bargain with him. I'm like, oh, yeah, I know. This is not my first trip to the rodeo or to China. So I'm bargaining with him and like we're quibbling about like one RMB, which is their currency, the yuan or the renminbi, which is like 16 cents. But I was like, no, it's got to be one less, not five, four, you know? And so, yeah, anyway, I love a bargain. So when you go to the car dealer and he says, oh, look, I'm not even making any money. This is what it costs us. I mean, first of all, they're lying to you because that's very complex there. Like if they sell so many, they get a bonus, or whatever it is. Some people say kickback, but I think that's a negative word. So yeah, they're not going to sell you the car at the actual cost. They're not going to lose money on the car. Not going to do it. You are not going to buy it at what it costs them. Not going to happen. And that's just what it's like with market makers. You can't actually trade at the fair value. If you're buying, you have to buy a little above it. If you're selling, you have to sell a little below it. But try to do as little as possible. Try and get the best bargain. So, initial thoughts on this. Which expiration do we sell? Which expiration do we buy? What is my plan? Because whenever I put on a trade, I know what my plan is to get out of it. I'm not just putting on a trade and thinking, geez, I hope it makes money now. I'm saying I'm going to buy it here, and my plan is to sell it here, and I'm going to put in a GTC as soon as I get into the trade. Or I'm going to set an alert, or I'm going to create a plan for rolling the option. And I'm just going to look at, all the criteria. I already talked about the chart. Are there when's earnings? I need to know that. Whole shebang. Earnings passed already in this example. I want at least my short option to be before earnings. Probably both, but at least my short. Is the chart in a channel? What is a channel? Well, I mean, think of the English channel. There's England on one side and France on the other. And it's like a little thing with things on both sides. Well, that's what a channel is in stocks too. There's support below it, resistance above it. It goes sideways. Is there a volatility differential? The volatility of the option you're selling should be at least 2 points higher than the volatility of the option you're buying. But it shouldn't be more than 20 points higher. Why? Well, if it's more than 20 points higher, there's probably earnings or something coming up. So you end up with something that looks kind of like this, right? You end up with a circus tent, basically, right? Isn't that what it is? A circus tent? You want the stock to either be under this pole, 265, or this pole, 275. If it's in the middle, the swag in the tent, that's okay too. If it's a little on this side of this pole or a little on this side of this pole, that's okay too. You just can't make too big of a move. In this case, because you're paying $1.90, the break evens are $1.90 below this one or above this one. Almost. I mean, it's, rough estimate. So the most you can lose is what you pay for it, $1.90. And how would that happen? Well, remember, I said if both options are out of the money so much that they're both worth zero, you lose what you pay. If both options are in the money so much that they're both worth parity, then you lose the time premium you paid too. So that comes into play here, right? The stock is so far down that both calls are worth zero and both puts are worth parity. I'm going to lose the $1.90 I paid. If the stock's so high, the 265 calls are both parity, I lose my time premium, and the 275 puts are both worth zero, I lose my time premium. So it'd have to make a pretty big move in order to lose 100%, but it can happen, obviously, right? So I need to monitor the chart. This is not a set it and forget it trade. I can do that with things like covered calls or cash cured puts, but not really so much with not really at all with time spreads or double time spreads or anything. I need to watch to make sure the stock's not moving too much. I need to monitor my Greeks. I need to monitor the implied volatility because I've got a potentially big Vega. If the implied volatility of each option changes too much, I could be in trouble. It's a volatility play and a time play. I really want to make my money based on theta, but implied volatility matters a lot. I always want to start it out with the edge. So here's another double calendar. Again, price is not current, not a recommendation, just an example. With Palantir around 175 or so, I buy the 180 call calendar, buy the 170 put calendar, and I end up with the same thing here. Circus tent. So now let's look at a double diagonal. Anyone remember what a diagonal is? A diagonal is, well, we know what a horizontal spread is, right? It's time spread. Same strike, different expiration. You probably remember what a vertical spread is too, right? Same expiration, different strike. So a diagonal is a combination between vertical and horizontal, right? It's both. So it's two different strikes and two different expirations. So here I could buy the 185 calls in the longer term, sell the 180 calls in the shorter term, buy the 165 puts in the longer term, sell the 170 puts in the shorter term. Now, remember before I said this could be called a strangle swap? Now's a good time to zoom in on that. If you think about it, I'm buying a strangle here, right? Buying out of the money calls, buying out of the money puts. And here I'm selling a strangle, selling out of the money calls, selling out of the money puts. And so this is basically the same thing as a double calendar, but I've just got tighter strike prices on the short strangle when it comes to a diagonal. Here, let's zoom in on this. No, actually, I guess we just covered this. Setting a typical diagonal. No. A common diagonal play is what we call the poor man's covered call. So that is buying a longer term in the money call, selling a shorter term out of the money call. And we're basically using the in the money call as a proxy for the stock so that we have something that's like covered call, except that we're paying a little bit of time premium on the long part on the stock, but with protection. So like if we're looking at a chart like this in NVIDIA, we could put on a poor man's covered call by buying the 190 long-term calls, sell the 200 short-term calls. You know, like in Mara, buy the deeper in the money $5 calls. This is when it's trading somewhere around 10 or something like that. I don't know what it is. Or, I guess I do know what it is. Yeah, it's trading around $10 by pretty kind of deep in the money, very long term, over a year until expiration. But, they're 50% in the money and then selling just out of the money really short term calls. Okay, so that's your typical diagonal, your poor man's covered call. A double diagonal is kind of what we're just looking at, right? We're going to use the same criteria as a double calendar, but what's the advantage of a double diagonal? Well, let's take a look. Here we got silver, right? We typically wouldn't think of something so volatile as silver as being a perfect example, but in this case, it's actually not a bad example. Here we're buying the 71.5 calls, selling the 71 calls in the shorter term expiration. That's not like the poor man's covered call. Here we're actually buying a higher strike than we're selling. With the put, we're buying a lower strike than we're selling. We're selling closer to the money. What is the advantage to selling closer to the money options? Higher theta, right? That's the big trick, the big secret to the double diagonal. Higher theta. We actually take on more risk with the double diagonal because we're not fully hedged. We're selling the 71 calls. So if we get assigned, we're shorting the stock at 71. And if we exercise these, we're buying the stock back at 71.5. So we have an extra 50 cents of risk, but we're just getting a lot more theta. And we're consequently paying less also. And so, if you're not that familiar with these, you can kind of trick yourself into thinking they're safer than they are. So, you always want to model them out. You always want to look at the Greeks. But that's the idea. You want to make sure earnings passed already, the stock's in a channel, and that you're getting that volatility differential. Now, as far as the differences here, double diagonal benefits and detriments compared to the double calendar, higher theta, lower vega, higher profit potential with the double diagonal because it's riskier. Or I guess I should say, but it's riskier, or because it doesn't matter. So that, friends, is everything we had to cover today. Hope that helps. Sorry that my voice was kind of crappy today, but next week we've got great stuff to talk about. Next week, we're talking about analyzing vertical spreads step by step. So you're getting a whole darn gamut this month. All right. Have a great rest of your day. Talk next time. Bye.